Have you ever pondered how the S&P 500 performs in a high interest rate environment? It's an intriguing question, isn't it? It's like asking how a ship fares in stormy seas compared to calm waters. And today we dive into that ocean of, in the world of finance, interest rates are that can either propel or hinder the ship of investment. They serve as a barometer for the health of the economy, influencing borrowing costs, returns on savings, and investment decisions. Now, when we talk about a high interest rate environment, it's akin to navigating through choppy waters. The cost of borrowing increases, making it more expensive for companies to finance their operations or take on new. This can often lead to decreased corporate profits, which in turn may result in lower stock prices. So how does the S&P 500, the benchmark of American stock market performance, fare in such conditions? In the words of Warren Buffett, be fearful when others are greedy and greedy when others are fearful. This quote emphasizes the importance of not following the crowd in investing, especially in a high interest rate environment. Historically, it's been a bumpy ride. The S&P 500 has had its share of peaks and troughs, reacting to interest rate hikes with increased volatility. It's like a ship racing against the waves, sometimes riding high, other times being tossed around. Scene script, voiceover. Now that we've set the stage, let's delve deeper into the S&P 500's performance during periods of high interest rates. As you can see on this graph, the index fluctuates over time, but let's turn our attention to the highlighted sections. These are periods when interest rates were high. Notice the peaks and troughs. They often coincide with these high interest periods. These spikes in the graph represent periods of increased volatility in the market. They occur when the cost of borrowing goes up, making it more expensive for companies to finance their operations or take on new projects. This can often lead to decreased corporate profits, which in turn may result in lower stock prices. It's like navigating a ship through choppy waters. The waves are unpredictable and can toss the ship around, just like the market during periods of high interest rates. So as you can see, the S&P 500 has experienced significant fluctuations during periods of high interest rates. It's a testament to the impact that these economic conditions can have on the broader market. But what happens when the seas calm down when interest rates are low? Let's explore that in the next scene. But what happens when the seas are calm, when we have a low interest rate environment? This is when companies can borrow cheaply, fueling growth and expansion. It often leads to higher corporate profits and subsequently an uptrend in stock prices. Just as Ray Dalio, a renowned investor, once said, the two biggest things in your life are your love relationships and your work. If you can get those two things right, you've got a great life. Relating to this context, a calm, low interest rate environment can be seen as getting the work right in the business world. It provides a platform for companies to grow and generate profits, creating a great economic life. The S&P 500 in these circumstances has generally shown a bullish trend, smoothly sailing on tranquil waters. Scene script, voiceover. Now let's turn our attention to the S&P 500's performance during periods of low interest rates. As we bring up this graph, you'll notice the S&P 500 index over time, with periods of low interest rates highlighted. You can clearly see an uptick during these periods as the index rides the wave of economic prosperity. Let's zoom in on these highlighted areas. Notice the bullish trends. These are not mere coincidences. They're the result of the low borrowing costs for companies, which we discussed earlier. This leads to corporate growth and expansion, thereby boosting their profits. As these profits climb, so do stock prices, and in turn, the index follows suit. This bullish trend is a testament to the power of low interest rates and how they can stimulate the economy and the stock market. It's like a gentle breeze filling the sails of a ship, propelling it smoothly forward. Clearly, the S&P 500 has shown a bullish trend during periods of low interest rates. It's a beacon of hope for investors, signaling growth and prosperity. But remember, while the calm seas and tailwinds are desirable, they're not always guaranteed. Like any seasoned sailor will tell you, it's always wise to prepare for any change in winds or waves. Next, we'll delve into the key takeaways in a high interest rate environment. Stay tuned. So what are the key takeaways about the performance of the S&P 500 in a high interest rate environment? First, expect rough seas. Increased borrowing costs can lead to decreased corporate profits, which can cause the S&P 500 to experience increased volatility. Second, The ride can be unpredictable. Like a ship in a storm, the S&P 500 can get tossed around, with stock prices fluctuating widely. However, it's important to remember that like a skilled captain navigating through a storm, seasoned investors and fund managers often find opportunities in these challenging conditions. As the legendary investor Benjamin Graham once said, the investor's chief problem, and even his worst enemy, is likely to be himself. Reflecting on this, it's clear that in a high-interest rate environment, maintaining calm and composure can be the deciding factor between success and failure. They understand that the storm doesn't last forever and calm seas eventually return. Scene script voiceover. Now, let's dive deeper into the key takeaways about the S&P 500's performance during periods of high interest rates, this time with some compelling graphical data to guide us. Show a graph of the S&P 500 index over time, highlighting the increased volatility during high interest rate periods. As you can see from this graph, the S&P 500 has weathered many high interest rate environments. Notice the rough seas, the increased volatility during these periods. These spikes and dips are indicative of the increased borrowing costs, leading to decreased corporate profits, causing the S&P 500 to experience this increased volatility. But remember, these rough seas don't spell doom. In fact, they present opportunities. Show a diagram illustrating how seasoned investors navigate through these challenging conditions. Seasoned investors, like skilled captains, understand how to navigate through these stormy conditions. They're not merely surviving, they're finding opportunities, capitalizing on the market's fluctuations. Show a graph highlighting the opportunities that arise in such conditions. Look at this graph. It clearly shows how some stocks outperform others during these high interest rate periods. These are the opportunities that skilled investors seek out, turning adversity into advantage. Even in the roughest of seas, skilled investors find their way. They understand that while the storm can be unpredictable and challenging, it doesn't last forever, and calm seas eventually return. The key is in knowing how to navigate through it all. So, as we venture further into understanding the S&P 500's resilience, remember these key takeaways and remember the opportunities that every challenge brings. So, whether we find ourselves in a high or low interest rate environment, the S&P 500 sails on, reflecting the sustained resilience and dynamism of the American economy. Peter Lynch, a renowned investor, once said, "Know what you own and know why you own it." This perfectly underscores the importance of understanding the resilience of the S&P 500. It's a journey of ebbs and flows, peaks and valleys, and through it all, the S&P 500 continues to chart its course, serving as a beacon for investors worldwide. Voiceover. Finally, let's visually appreciate the resilience of the S&P 500, regardless of the interest rate environment. On screen now, you'll see a long-term graph of the S&P 500 index. Notice the overall upward trend, a testament to its resilience. As we zoom in on different periods, you'll see the fluctuations, the ebbs and flows, peaks and valleys. But the big picture remains the same, a consistent overall growth. This is the S&P 500 navigating through various economic conditions, high or low interest rates, and still pushing forward. The resilience of the S&P 500 is not just a marker of the American economy's dynamism, but also represents a beacon for investors worldwide. It's a beacon that has guided countless investors, offering a sense of direction amidst the stormy seas of the global economy. Through all the ebbs and flows, the S&P 500 continues to chart its course, a testament to its resilience and the unyielding spirit of the market it represents. So, whether you're a seasoned investor or a novice, remember this visual: the enduring resilience of the S&P 500. It's a compelling reminder of the potential that lies in long-term investing, regardless of the interest rate environment.